Good morning, everybody. This is the live market open for Friday. Happy Friday. It's February 26th. We're finishing a very busy week. I'm Yohay Elam of Forex Crunch and Market Movers podcast, doing the show as usual for FX Street. As usual, on Friday, we'll finish the show with a preview for next week's events. But before that, and we'll do what we do here every morning, cover the recent developments in markets, talk about the various charts and levels, the next, less than 24 hours, and of course, answer your questions. If you cannot see the chat box alongside the video, please go to the address here on the screen, tlk.io/fxstreet-forex-live-video. Okay, good morning, Fabian. Good morning, everybody else here in the room. Let's begin. First of all, it's Friday. I hope everybody's ready for the weekend, and also markets seem to be ready for the weekend with a better market mood. So oil is going up, stocks are doing okay, and I think one of the most interesting developments, okay, it's a risk-on environment. We have rising commodity currencies, rising pound, rising oil, rising stocks, but what's surprising is also that the euro joined the risk camp. So now we have the dollar and the yen as the safe haven currencies. Of course, the yen remains the number one safe haven currency, but the euro joined this camp. Okay, so this is euro dollar. It's trading very, very nicely in the well-defined range. Okay, we talked about this range a few times this week as 110.70 working as resistance, very, very nicely, and 109.60 worked as support. Now, yesterday, I guess also this morning, as we're seeing the market mood become more optimistic, rising oil prices, we had better figures in the United States, we'll talk about that later. We're seeing euro dollar moving up, okay? It seems that at least for now, or perhaps until at least the ECB meeting, we'll have the euro move together with the pound, move together with commodity currencies, and not alongside the Japanese yen, okay? So euro dollar currently 110.56. Pound dollar is also recovering. We even had a small rise above 140, right? But we never went too far with that. Remember, the pound is still suffering the devastating effects of Boris Johnson's support of Brexit. Okay, in general, the uncertainty about the UK's role in the EU, should I stay or should I go, just to be or not to be, if you wanted a more Shakespeare way. Anyway, currently just under 140, some kind of support there at 139.50, 139.60, not really significant. Further, I mean, the near 7-year low has been 138.80. Okay, so that's the low support. High resistance 140.50, 141.25. Okay, what happens when we have risk on? We see a sell-off of the Japanese yen, right? So dollar yen is certainly above the abyss. We already saw it falling all the way to 111, level where previous time reached 111. We had the Bank of Japan intervene to push it a bit higher. This intervention didn't work too much, but this is clearly a double bottom, a very, very strong line of support. 113.20, line I mentioned yesterday, 113.30. This is a line of resistance. So far, resistance is holding. The pair already broke above 113. Now it's a bit sliding, but all in all, dollar yen remains a bit higher thanks to a better market mood. Dollar CAD. Here we have really significant movements. Big fall of the dollar against the Canadian dollar. Big rise of the loonie. The Canadian dollar is showing us a lot of strength. It's rising together with oil prices, but not falling that hard when oil prices are falling. So we have a clear drop under resistance, under what used to be support, now works as resistance, 136.20. We've reached, got close to 135, currently above these levels. We're now at the lowest levels, I think, for the year. Let me look a bit outside. Yeah, look at this tremendous rise of dollar CAD. We had the previous high of 134.60. Now this turns into support. Then we had it rise all the way almost to 147. The big turnaround came, of course, when the Bank of Canada decided not to cut rates at the end of January. Since then, we've been falling. It's never a one-way street. But yesterday we had one of the biggest falls in dollar CAD, one of the biggest leaps in the Canadian dollar, thanks to a fresh rise in oil prices. Of course, have to talk about oil prices, WTI crude oil, when we're talking about CAD. So here we are, currently 33.40. On the day it's up 1%, but yesterday we had a big rise. The 34 level remains resistance. Anyway, if you remember, we've been not so long ago, nearly at $26 a barrel on WTI crude oil. So that's something like $7 off the lows. That's huge. That's 25%. Moves in oil prices remain big. Yesterday we had, you can attribute these comments that there's going to be a meeting between Russians, Saudis, and other members of OPEC and non-OPEC members to discuss some kind of a production freeze. Remember, there's a lot of trust that needs to be built. The US shale industry can always pump oil. I see this more as a correction than as a big change in direction. But anyway, it's important to note that currently the mood is positive, oil is rising, stocks are rising. That has an impact that goes way beyond the Canadian dollar. Let's continue to another commodity currency, the Australian dollar. 70 to 20 still works very nicely as a separator of ranges. So when the mood improved, we went up once again, got closer once again to 72.60. 70 to 20 works as support, followed by 71.40. So we're back to the high range. There are still doubts, of course, about Australian economy, China, and things like that. But with the better market mood, we're seeing the Aussie rise. Okay. Kiwi dollar is already performing much better. Why is that? First of all, better market mood means demand for the Kiwi. And we had a very, very good trade balance report in New Zealand that showed a surplus instead of a deficit. And that also helped the pair not only break above 67, but even top 67.40. No, sorry. Temporarily, we topped that, but we didn't go. No, we're still above that. Sorry, this works as support, I would say. 67.40 to the upside. We are at levels last seen in quite some time. So, yeah, so I would say 67.90 is the next line of resistance. And the one afterwards is only 69 cents, okay? So in general, we broke above a very long and annoying range. Now we're on higher ground. Let's see if we can hold on this high ground towards the end of the week. If we can see a challenge of 67.90, we got close to that or not, okay? Let's continue with other currency pairs and then talk about the events we had yesterday. Dollar Swiss, not going anywhere fast. Currently at just under 99. Okay, so 98.50 to 99, I would say, or yeah, works as some kind of range. Parity above is a strong line of resistance. Further support on the downside at 98.20. Okay, Euro Swiss recovering a bit. Maybe we have some intervention by the S&P there. Anyway, 109.30, 109 works as support, 110 as resistance. We had probably some kind of intervention a few weeks ago, and now perhaps the S&P is letting go. Euro yen, here we had, Euro pound, currently just under 79. We've already seen higher levels. When I talked about this pair, I talked about the weakness, of course, in the pound because of the Brexit talks and the euro working as a safe haven currency. But at least in the recent days, at least from yesterday, at least, we're seeing the euro work as a risk currency. That means more alongside the pound than against it. Anyway, let's add another line here. I think it's a very interesting cross. It's also important to remember that if Britain leaves the European Union is left also without Britain. That means Of course, Britain will suffer more. The UK will suffer more than the Eurozone, but the Eurozone will also suffer. Anyway, 79.30 is resistance, 78.50 is support. Okay, let's continue with Euro Yen. The departure of Euro from the safe haven camp, the very exclusive safe haven camp, yeah, back to the wider pool of risk currencies, means that Euro Yen moves together with the mood, better mood, higher Euro Yen, worse mood, stronger Yen, weaker Euro. We found support there at 122.40, and we went all the way up. 124.20 works as support at the moment at these higher levels, and 125 is very nice resistance. Euro Yen lost a lot of ground. We've seen how the demand for the safe haven yen in previous weeks boosted the yen also against the euro, even when the euro was a safe haven. Now, when I sort of exclude it from the safe haven camp, then yeah, we're seeing it trend in a much better manner. Pound yen, this has always been the risk on, risk off currency pair. Currently better mood in markets. Once again, we have the pair, this cross. It fell already to 154.66. Now it's over, that's over 300 pips from the bottom. It has some support here at 157.30, resistance 159, no, 160, the very round number. Okay, better market mood. We could see the pair move higher, but if things go south, we could see this pair fall as well. Okay, covered quite a few currency pairs this morning. I see a few questions here before we move to the events yesterday and today. So good morning to everybody, to Fabian, Artem, Dima, Ralph, Reg, Jake, and yeah, Kiwi had a good performance run. Yeah, they reported a surplus of $8 million Kiwi in New Zealand dollars, which is not so huge for trade surplus, but they were expected to report a big deficit of around 300 million. And together with rising oil, rising commodities, we're seeing a better market move. Okay, sorry, a stronger Kiwi. It finally broke out of the range. It's now on higher ground. Good morning. Another question from Fabian. Why today you have the charts in 30 minutes instead of 1 hour? Yeah, I'm changing the charts to make points, of course, to have either zoom in or zoom out. So it's 30 minutes, sometimes 1 hour, sometimes daily charts. You guys prefer hourly charts? I use half-hour charts, especially when I want to show the impact of events, because many events are released at the bottom of the hour, such as US events at it's 8:30 8:30 Eastern time. That means 1:30 GMT, or UK events. Yeah. Okay. Anyway, let's talk about the data that we had yesterday, which was quite significant. Right. So, first of all, we had no surprises from the UK GDP. The economy in the UK grew 0.5% quarter over quarter and 1.9% year over year. No surprises there. Remember, the focus is still the political focus in the UK. What we did have a surprise from Eurozone inflation. It was downgraded. The headline figure was downgraded to 0.3 instead of 0.4 originally reported. Core inflation was not changed at 1%, but that was sort of lower headline inflation. The ECB has a target of 2% or a bit below on headline inflation. Yeah, so we had it falling. Yeah, we have more sort of for the ECB more fuel to act. Okay. The big event of yesterday was the durable goods orders release from the United States. It came out far better than expected. Perhaps I'll show it here on the FX rate calendar on Forex Crunch. I don't have it readily available. I'll get it for you just in a second. So That was Thursday, right? Oh, it's already today. Just a moment. Why can't I get it on the screen? Here we are, sorry. So, look at the figures. They came out, durables goods orders, 4.9% jump. In addition, there was an upgrade of the previous figure, right? Anyway, it's double the early expectations, and also the core figure. It was expected to rise only 0.2, it rose 1.8. Also, a huge surprise, the core durable goods orders, excluding transportation, reflects long-term investment, okay? So when we have more long-term investment, this is a good sign for the Fed. It also added to the positive mood. We did have a very, very minor miss on US jobless claims. Initial jobless claims came out at 272 instead of 270, but I would not say that's a big deal. In general, durables goods orders were more important. So that was really the good news from yesterday. Here, if we're already looking at the calendar, we can see here the trade balance in New Zealand. All the figures came out better than expected. Trade balance, last figure here, showed a surplus, but also exports and imports came out better than expected, showing more trade activity in general, which is of course good for the economy. Last but not least, or perhaps least, Japanese inflation came out at the normal mediocre levels. Okay, it implies more action from the Bank of Japan in its next meeting in mid-March, in the Ides of March. Yeah, perhaps a bit better than expected on the Tokyo CPI, excluding fresh food, which is a fresh figure for February. It's not the national one, but it's only for the capital region, but it's still of importance. The other ones came out more or less as expected. On the national, you can see here it was a bit lower, excluding food. All in all, there's no real inflation in Japan. The Bank of Japan remains frustrated. It did a lot in setting negative rates, prints a lot of money, and also, also made some kind of intervention in markets, intervention which was short-lived. Markets have a stronger say than, we have here a comment. Good afternoon, good morning, wherever you are. What are your thoughts about the upcoming US GDP? Of course, we'll talk about that. What time frames do you usually see setups? I usually look at the daily and the hourly charts, and I don't trade. I focus on analyzing and publishing on Forex Crunch. When I did trade, I looked for the bigger trends on the daily charts and the smaller, and for entry and exit points on the hourly charts. Okay, what are your thoughts about the US GDP? Needless to say, this is the main event for today. It's an opportunity to mention that we'll have live coverage. It'll be Dale Pinkert, Mauricio Carrillo, and myself. The event itself, it's released at 1:30 GMT. We'll begin the broadcast, if I'm not mistaken, at 1:15 GMT, 15 minutes before. That's the main event of the day. It's the second release, or the first revision, of GDP growth for the United States for the fourth quarter, okay? This is the main figure, the headline figure. Last time, the first estimate showed a very, very poor growth rate of 0.7 annualized, okay? This is not comparable to the UK's 0.5 quarter over quarter. If you compare it to the terms that are used in the UK, it's 0.2 in the US, okay? Because it's 0.7 annualized. This time we're expecting a downgrade to nearly no growth, to 0.4 annualized, okay? So expectations are quite low. Expectations are low for Q4, and for Q1 2016, expectations are already much, much higher. Okay? Anyway, this is the main event for the day. But there are also other things to watch. We have at the same time releases of the core personal consumption, personal spending, things like that. The one I focus on is the one the Fed focuses on. It's the core PCE price index, okay? But for January, not the one related to the GDP release, but the one for January, it's expected to slide from 1.4 to 1.2. Why am I talking about this? Because this is the Fed's favorite inflation figure, okay? When the Fed cares about core inflation, not about headline inflation, okay? So if you pay more for food and for oil, for gasoline in the United States, it's meaningless for the Fed, to put it sort of in blunt terms. But the core inflation, especially this one, more than the core CPI, is what the Fed focuses on. Anyway, but it's still worth mentioning. But remember, GDP is more important. Let's talk a bit more about GDP in the United States. So let me put the camera on myself for a second. So why is GDP important? It's the sort of bottom line figure of economic activity in every country. In the US, it's one of the more peculiar ones. Everybody looks at this figure, but there are three releases that usually there are big revisions between those releases. We have the preliminary, the advanced, the preliminary, and the final. And even the final is not the final one, because we can have a revision of that in the next quarter, or once a year we have annual revisions. So it's quite a mess. Nevertheless, it has a lot of impact because many things are derived from the growth rates that are reported. But usually in the revisions, and not only the headline figure is important, not only fall from 0.7 to 0.4, but also the composition. Okay, what's good and what's bad in GDP? Exports are good, naturally. If we have more exports, it means, well, it's something positive, and the US is a more closed economy, so any addition in exports is good. Investment is good, of course, it has long-term implications. Okay, personal consumption is considered positive in the United States. I have doubts about that because, if you just consume and buy and buying from each other, I'm not sure it's necessarily a good thing. But if we have higher personal consumption in the GDP, it's considered a positive report. If personal consumption beats expectations, it's a good figure. What's bad in GDP? What kind of growth is not good growth? Government growth, more expenditure by the government. If that contributes more to expansion, it means the situation isn't good and the government needs to help. And even worse than that is inventory growth, okay? Because if you build inventories in Q4, if you had built inventories in Q4, that implies that in Q1 you'll have to deplete them. That means it adds now to growth, but then it'll weigh down on growth in the near future, okay? So when you have weak growth rates that are a result of depleting inventories, it's not that terrible because you know that these inventories will likely be replenished in the next quarter. Okay, so it's still the headline figure is the most important one, but also before jumping into a trade, please do look at a bit at the details. Which kind of growth is it? Is it more consumer-based, investment-based, or is it more inventory, government-based? Okay, so that's sort of my 2 cents on what type of growth we want to see. I hope I answered your question there. Yeah, I think I don't have an opinion regarding where I see if I think it'll be better than expected or worse than expected. Okay. I think it'll have an impact because it's sort of the bottom line event for the whole economy, and and today's Friday. That means that markets are more sensitive to data, want to feel the final touch of markets. Okay. What are the main data that influence on GDP. Well, GDP is composed of well, imports, exports minus imports, consumption, investment, government spending. Of course, most of the US economy is consumption. Okay. Let's see what else we have today on the agenda, because it's definitely not the only event. Okay. So we talked about personal spending, personal income. Of course, the higher the better, but they'll be a bit overshadowed by the GDP report. Core PCE price index, as I detailed, it's a Fed favorite. It's expected to fall. In general, expectations today are low. A fall of GDP and the fall of the core PCE price index. If we have small beats on both of them, I think we could have sort of continued positive market mood with the dollar probably gaining. And if they miss low expectations, it could be negative. Anyway, we also have the revised edition of the University of Michigan's Consumer Sentiment at 3 GMT. Big surprise is expected there. And we're expecting a small upgrade from 90.7 to 91. Not really significant. Okay. Anyway, it's the second release. It's not that important. Okay. But we have more figures coming out right now. So first of all, today we also get German inflation figures. Now, throughout the morning, we'll get data from the various German states. Germany is composed of 16 states. We have them releasing their initial preliminary inflation figures throughout the morning. And at 1 GMT, we have the final figure. Okay, let's see if I can get from you some data. Yeah, we have Saxony reporting already. And they show it's a drop of 0.1% year over year. Okay, let's still focus on the main figures. What are the expectations, right? Here we go. So it's released at 1 GMT, 2 p.m. here at the old continent, Central European time. So what's important is the year-over-year figures. Unfortunately, there are two separate ones. One is the German national calculation, and one is the HICP. I think it's more important because it's the European standard, and that's what feeds into the all Eurozone inflation figures. So this one is expected to fall this time from 0.4% year over year to 0%. Okay, the HICP, Harmonized Index of Consumer Prices. Everything is harmonized here in the Eurozone. Anyway, we're expecting a fall. The national figure is also expected to fall. I mean, they usually go hand in hand, but it's not exactly the same figure. So the national German figure is expected to, where did that go? Here we are, from 0.5 to 0.2. Any deviation from these numbers, if it's positive, of course, it implies less action from the ECB. That could be euro positive. And if we have a miss, if we have worse than expected inflation figures from Germany, it implies worse inflation figures on Monday from the all-European figure, and then more chance of ECB action, okay? So we already heard from German policymakers, from the Bundesbank, that they are ready to act in March. They also joined the dovish camp. It's not Draghi on his own with a few doves. It's already, even the hawkish members are ready to act in March. But let's see. These figures, of course, impact their decisions. We also had already inflation figures from Spain, where I'm located. That was released at just when the show began, and that showed a worse than expected drop in prices. Last time it was 0.4 to the downside. it was expected to worsen to 0.6, but it fell all the way to zero. I mean, a fall of 0.9. So it's, of course, it also feeds into the all European figures. Spain is the fourth largest economy in the Eurozone. Germany is, of course, the largest one. Let's see if we have something from France. No, France will not release it today. Anyway, so watch out for the German figures. I think we're already beginning to see some falls in euro dollar. Yeah, quite a fall there, perhaps from the release of the German figures and from the Spanish figures. So, well, we're still falling in range. It's not that dramatic, but resistance at 1.70 certainly works. Now we're sliding to the downside, I think, because of inflation figures. Of course, the final ones are more important. Anyway, technical lines work here very well. Now, I've seen here a question from Jake, nothing on the G20 meeting. That's right. Members of finance ministers and central bankers from a group of 20 countries are meeting in China, and they're trying to discuss the global economy and perhaps decide together on taking measures. In the past few G20 meetings, we had basically nothing worth mentioning, very empty, very hollow statements, working together to stimulate growth, nothing really, nobody's pledging to take action. What we did here so far is from Wolfgang Schäuble, the German finance minister. He said that monetary stimulus has reached its limits, and basically said there's nothing we can do. He's not alone there. Of course, the United States is there, China, Japan, and maybe they'll eventually they'll agree on some kind of communique, which will say we're working together to make a better place or something like that, but no real action. I mean, the last meaningful G20 meeting was in 2009, early 2009, just after the financial crisis. Since then, maybe it's worth mentioning that in 2013 they decided that countries should not intervene in foreign exchange markets. Of course, it was a meaningless statement with no sanctions, no details. So we might hear an influx of headlines from China today, from the G20 meeting, but I don't think we'll have any meaningful decision. So it's going to be a lot of noise and not too much action. That's what I believe. So yeah, let's see if there are more events that I wanted to talk about today with you. Sorry, I cannot say much more about the G20 meeting because I'm used to. I don't want you to be disappointed. I'm going to be disappointed. I would have been disappointed had I watched it closely. Anyway, after the main US figures are released, we have in the afternoon here in Europe, or in the morning, mid-morning, noon in the United States, we have FOMC's Jerome Powell speaking at 3:15 GMT, and just before markets close at 6 GMT, we have Lyle Brainard of the Fed. She is a dove. She spoke against raising rates eventually. She did vote for it, but she was sort of one of the more skeptic members of the Fed. Let's see how she reacts to GDP figures, recent figures, other figures which were generally positive, not all. Of course, we had weak new home sales this week, but we had an excellent durable goods orders report, good retail sales, higher inflation on the CPI. We'll also have the core PCE price index. Let's see how she reacts to all that. Anyway, nobody is expecting a rate hike in March, but and implied volatility even shows that there's no chance of rate hike until next year. I still think there's a chance that the Fed will raise rates in June or perhaps in September. It'll of course work very, very cautiously, but the economic situation in the US is not terrible. Okay, so yeah, that's what's going on. Okay, let's see if you have any more questions and we'll begin the early beginning of the wrap-up, and then, of course, the preview for next week, as we do here every Friday. Okay. Anyway, if you have questions, I can always answer them at the end. Where did my mouse go? Okay. So this is the wrap up for the live market open for Friday, February 26th. Happy Friday, everybody. The mood markets are certainly ready for the weekend. We have a better market mood in general. Let's see if this continues. It's never a one-way street. Oil is generally on the upside. Stocks are doing okay. G20 summit begins. Don't expect too much. I mean, expect a lot of noise, but no action. For me, the big shift is that the euro joined the risk camp. So it's moving more with commodity currencies, less with the yen, okay? Again, these correlations don't last forever. Everything changes all the time, but this is the current situation. Euro dollar is trading very, very nicely in a very well-defined range. It doesn't happen every day. This is usually a much more messy currency pair. So current range 109.60 to 110.70. 110.70 is very, very strong resistance, as it was demonstrated just now. 109.60 was resistance in the past, now works as support. Okay, we have inflation figures from Germany and we had weak data from Spain. But of course, the focus will shift to the United States. In the pound, we had it cable made a small move above 140. Still hesitating, still too much talk of a Brexit, of Britain leaving the EU. Support 139.60, higher resistance 140.50, 141.25, lower support 138.80. Dollar yen, when things look good, you sell the yen. The yen is the number one safe haven currency. 113.20, 113.25, I would say, is resistance. Support, clear support, a double bottom there at 111. Higher resistance at 114.25. We had inflation figures from Japan. They showed ongoing mediocre rise in prices, far from the Bank of Japan's target. But of course, also here the focus moves to the United States. The Canadian dollar, a big winner, enjoying the rise in oil prices and not falling too much when oil prices are falling. It broke below support at 136.20. Next level to watch is 134.60, which was very, very tough resistance for a very long time. Okay, so I have a stronger Canadian dollar in general, showing a lot of resilience. Aussie dollar, well, now battling in the separator of ranges, 72.20, further support 71.40, and 70.50, higher resistance 72.80. 72.20 is not so strong as it used to be. Currently, the pair is only just holding above it. Kiwi dollar, here we have a clearer trend. 67.50 is the current level, above support at 67.40. The next level is 67.90, followed by 69. Okay. Support, lower support at 65.50. We had a trade in this range of 65.50 to 67 for a very, very long time. Okay, events for today in the wrap up. Yeah. From now, we already have figures from Saxony, which were poor. We have German inflation figures. The final release is at 1 GMT. These are preliminary numbers for February. Yesterday, we had the final Eurozone figures for January. Today, we have the preliminary German figures for February. On Monday, we'll have the preliminary Eurozone figures for February. Anyway, Spanish CPI came out worse than expected at minus 0.9. Adds to the chances, of course, that the ECB will act on March 10th. The countdown continues. Anyway, the big event for today is at 1:30 GMT. That's the second release of US GDP. We begin our live coverage at 1:15 GMT, 15 minutes before the event. Dale Pinkert, Mauricio Curry, and myself, you're all welcome to join. Together with that, a small downgrade there is expected from 0.7 to 0.4, annualized very poor growth. We all expect US growth to rebound in the first quarter of 2016, but the fourth quarter was really bad. Let's see how bad it really was. And we have also another figure to watch. We have a big bulk of US figures, but an important one is the Fed favorite core PCE price index. Okay. I also have the revision of consumer sentiment. It's the second release, therefore less important. And we have speeches from Powell and from Brainard, which is a dove. I think her speech is more important than the one by Powell. Anyway, GDP remains the main event. Okay, and all in all, we're still in a better market mood, thanks in part to yesterday's durable goods orders. They disappointed so many times in 2015, and they finally jumped so much in the headline and the core figures. So it's finally all good. What I forgot to mention regarding the Kiwi is that it enjoyed the positive trade bounce, which was a very good surprise over there. Okay, that's it for the wrap up for today. We'll soon begin the preview. Let's see quickly. Pairs to watch for today. Regular question by Jack. So I think euro dollar, because of the mix of the German inflation figures and US GDP, but also I would be watching the Canadian dollar because of oil prices, and let's see if they're now sort of they're at the top of the range, and let's see if this continues. And then also I would mention the British pound, because the British pound had a terrible week because of the Brexit talks. It fell to the lowest levels since March 2009, since the last time that the Bank of England changed its interest rates. All right, so we're let's see how it closes the week. If with the current trend, which is a bit higher, which was a bit sort of a sweet end, some comforting end to a terrible week, or if it resumes its falls and closes on even lower ground. So I think it'll be very vulnerable, very political week in the UK. Okay, now let's begin the preview for next week. So this is the preview for the week beginning on February 29th to March 4th. We have February 29th, once every 4 years, and we have the beginning of a new month, which means top tier figures from all over the world. So before the month ends, long February, we have the European inflation figures, preliminary for February. Today we have the releases from Spain and from Germany, which feed into this figure, but it's still a big surprise what we'll have there. This is the last inflation report before the ECB's meeting. Very important. On Tuesday, March 1st, we have all the things that happened on the first day of the month. So it's Chinese PMIs. They have an impact on global growth, both the independent one, the Caixin one, and the official government one. And we have the Australian rate decision. RBA is not expected to change the rates from the current level of 2%. The Australian dollar is weak enough. The Australian economy is also doing okay. China is an issue, but inside other sectors are okay. Canadian GDP, it's a monthly GDP report. This time it's for the month of December, so it's the final one for 2015. Should be more interesting than the other ones. Let's see if it has a material impact, long-term impact on the Canadian dollar. And we have the first hint for the non-farm payrolls coming from the ISM manufacturing PMI. Remember, the last reports were bad. They showed that the manufacturing sector is, if you wish, in a recession in the United States. So services is okay, manufacturing is poor. Employment component is relevant for the non-farm payrolls report on Friday. On Wednesday, we have Australian GDP. Of course, an all-important figure for the Aussie dollar. And we have the second hint for the non-farm payrolls. We have the ADP NFP. It's only the private sector, but it's we have seen a good correlation between this number and the official NFP in recent reports. So that'll be another build-up. We have the oil inventories as we have every week on Wednesday. Also, it has a big impact on the mood. Thursday, we have US jobless claims, not so much as a hint as the next one, which is the ISM non-manufacturing PMI. The employment component of the services sector is considered a big hint towards the non-farm payrolls. Higher employment, higher hiring intentions mean usually a stronger report. Okay, and on Friday we have the Chinese trade balance as a warm-up. We all know that's important because of the level of imports and exports for the number 2 economy, and then jobs report from the world's number 1 economy, the US non-farm payrolls. I don't have the expectations at this moment, but I believe they'll be a bit higher than last month's 151,000 jobs gained. And of course, as always, wages will be very important to watch over there. Not only the gain in jobs, but also the change in wages, which was quite positive in recent months. Okay, that's the report for February. All right. So these are the main events for next week, which is a very busy week. Anyway, okay, I see no more questions. So I want to thank everybody that came to the show today and throughout the week. I hope you enjoyed it. Any kind of feedback is, of course, welcome. And wish everybody a safe and successful trading day, as always. See you on Monday with a new week, new energy. Hope this positive market mood continues, and the figures today will also be positive, and volatility may be with you. Remember, when there's higher volatility, there's also more opportunities to make money, but more opportunities to lose money. At least what I'm happy to see, I think I mentioned a few times, is that Eurodollar is trading in a well-defined range. This does not always happen. But on this positive note, I want to thank everybody once again. Have a great weekend, a great trading day, and see you on Monday. Thank you, and bye-bye.